You've just lost a parent. And on top of the grief and the family dynamics, suddenly you're dealing with bank accounts, a house, IRAs, Roth IRAs. What goes through probate? What gets taxed? What do you have to do and when? I've got a walkthrough of a very typical inheritance scenario so that you know exactly what you're dealing with. Got that and more coming up. When a parent passes away, there is so much going on all at once. Emotionally, logistically, and yeah, financially as well. We've helped a lot of families navigate this transition, and the families that handle it the best are the ones who were proactive and set up the right estate plan and structure ahead of time. To do this, it's important to understand, at least generally, how the different pieces of the estate plan work, because not all assets behave the same way when someone passes away. Some go through probate, some don't. Some come with a tax bill and some don't. And if you don't know which is which, you could make a mistake that costs real money. So let's walk through a very real scenario that also hopefully is fairly typical. Here's a scenario. Your surviving parent passes away. They leave behind 4 buckets of assets. The first one is a bank account, maybe some CDs, totaling about $100,000. Second, the family house, worth about $300,000. Third, a traditional IRA worth $500,000. And fourth, a Roth IRA worth about $100,000. You and your siblings, so the two of you, are now trying to figure out what to do next. So let's take each one of these and answer 2 big questions. Does it go through probate, and is it taxable? Before we do, a quick word about probate. Probate is the legal process of setting up an estate through the court system. It's validating the will, paying off debts, distributing what's left to the heirs. And the reason why it matters, probate takes time and it can cost money as well. We're talking months, sometimes over a year, depending on your state. And in some states, probate fees and legal costs can run 2 to 5% or whatever the value is that goes through the probate estate. So whether or not an asset goes through probate is a really big deal and could have real dollars attached to it. All right, now back to the scenario. Asset number 1, the bank accounts and the CDs, $100,000. Here's the question. Does your parent have a beneficiary designation on these accounts? Or maybe are they titled jointly between your siblings and your parent? If yes, then there's a named beneficiary or a joint owner that instructs where the dollars go, no probate. However, it's more common not to have those things listed, especially for a surviving parent. If those accounts have no beneficiary designation and they're just in your parent's name, they're going to go through probate. And because of that, even just a simple asset like cash can take a lot more time to distribute and can have additional fees to it as well. So in our scenario, let's say these accounts were in your parent's name only, no beneficiary listed, that $100,000 is going to go through probate. Now, is it taxable? Here's the good news on this one. When you inherit cash or cash equivalent assets like a CD, you generally don't have to pay income tax on that money. Whether or not your state has inheritance taxes, that's a separate item. You'll want to know that working with your CFP for your specific state. But for income taxes, yeah, you generally don't have to pay income taxes on this money. There's no capital gains tax either because cash really doesn't appreciate. So that $100,000 you ultimately receive, yeah, probably going to go through probate, but at least it's not taxable to you. Asset number 2 is the house, in this scenario worth about $300,000. Probate or not? Again, it depends on how it's titled. If your parent owned the home in a revocable living trust, for example, then it's not going to go through probate. If the home had a transfer on death deed or TOD deed where they had beneficiaries listed, again, it's not going to go through probate. But if the house is in your parent's name alone and it's not in a trust and there's no TOD deed, it does go through probate. In our scenario, this is common. Single surviving parent, home in their name. Yes, the $300,000 house is going to go through probate. Now, is the house taxable? This is one of the most powerful and underappreciated features of the tax code, and especially when it comes to houses and later stages of life, this can be very, very important. It's called the step up in basis at death. And here's what it means in plain English. Let's say your parent bought the house 30 years ago for $100,000. Now it's worth $300,000 today. If they gifted it to you while they were still alive, maybe near the end of their life, and you didn't live in it for 2 out of the last 5 years, then you're going to have a capital gain when you sell it. The difference between that $100,000 and $300,000, because it was gifted to you, you're going to have to pay tax on it. However, if you inherit it when they pass away, the tax basis gets a step up to whatever the value was the date of their death. So the basis is now $300,000, and if you sell it shortly thereafter for $300,000, there's zero capital gains tax. Nothing. That built up gain just disappears for tax purposes. This is a significant benefit. Now, if you hold on to the house maybe a little bit after they pass away and you eventually sell it for $350,000, well, then you'd owe capital gains on that $50,000. The difference between the value as of the date they died, $300,000, and the value you sold it for, $350,000, there would be a step up in basis to the $300,000. You'd owe taxes on that $50,000. Asset number 3, the traditional IRA, $500,000. Does it go through probate? No, it shouldn't. This is the power of having a named beneficiary. Because you and your sibling are listed as beneficiaries on the IRA, this $500,000 transfers directly to the two of you, completely outside of the probate process. The will doesn't control this, the court doesn't touch it. Each of you gets your share, $250,000, and you work directly with the financial institution to set up your own inherited IRAs and direct your portion into that. The key point here is you need to be listed as the beneficiary, not just a pinky swear, not just, written on a handwritten note, and not in your will. You've got to be listed as the named beneficiary with the IRA financial institution. Now, is it taxable? Yes. And this is a big one. Every dollar that you pull out of that inherited traditional IRA, that's going to be taxable to you at ordinary income. Think about that. Your parent put in money into that IRA over, decades ago, got a tax deduction every single time they made a contribution, and all that tax has been growing tax sheltered, tax deferred. Now it's time for that tax bill to land on you. And here's what changed. It's with the Secure Act 1.0. Under the old rules, you could stretch out this inherited IRA over your lifetime, just withdrawing a little bit every single year, potentially decades of additional tax deferred growth. Under the new rules, though, for most non-spouse beneficiaries, you have to drain the entire IRA within 10 years. That's the new 10-year rule. That's it. And if the original owner was already taking the required minimum distributions, you have to take an annual RMD as well during those 10 years. So what does this mean in practice? Let's say you're 55 years old when you inherit your $250,000 inherited IRA. You've got 10 years to take all that money out. If you're still working, every distribution you take is added on top of your regular income. This could push you into a higher tax bracket right during your peak earning years. So this is where the planning really matters. You want to be very intentional about how much you pull out each year and in what years and how it interacts with your overall tax picture. This is a multi-year tax planning exercise, not just a one-time decision, because you've got 10 years to stretch this withdrawal over. And finally, asset number 4, the Roth IRA, $100,000. Probate? No. Same answer as the traditional IRA. As long as you're a named beneficiary, the asset passes directly to you outside of probate and no additional expense there. Is it taxable? And that's the good news. You understand how the Roth IRA works, right? Withdrawals, as long as the original IRA account owner passed that original 5-year rule where they had a Roth IRA for at least 5 years, then the withdrawals are going to be tax-free. It would have been tax-free withdrawals to them. It's going to be tax-free withdrawals to you as the beneficiary. But again, as long as you're listed as the beneficiary, the same 10-year rule is going to apply like it did to the traditional IRA. You have 10 years to fully withdraw that inherited Roth IRA. The difference is those distributions don't create a tax bill, and you don't have to take an RMD from them every year as well. So there's less urgency to rush to the withdrawals with an inherited Roth IRA. You can be strategic. Let it keep growing tax-free as long as possible within that 10-year window. So let's bring that all together. The bank and the CD's $100,000 likely is going to go through probate if there's no beneficiary name, but it's not taxable to you. The house, $300,000, again, likely to go through probate if it's not in a trust, but the step up in basis means very little or no capital gains tax when you sell it. The traditional IRA, $500,000, it's going to skip probate because you're listed as a beneficiary, but it's fully taxable to you and you've got to withdraw it within 10 years. Same with the inherited Roth IRA. It's going to skip probate, but all those withdrawals are going to be tax-free. Guys, this is exactly why we talk about looking at all 6 areas of your financial life in an integrated way. Because any inheritance like this doesn't just sit in a box. The inherited IRA affects your tax planning for you and the next generation as well. It affects your retirement income plan. Those distributions could change your tax bracket in retirement, could even change your retirement goal. The inherited Roth, right? There's investment strategies there so that you can optimize the 10-year period. You cannot look at any one of these pieces in isolation and make a great decision. You have to look at the entire picture together. And here's the other piece. If you're watching this and looking at it from your parents' estate plan, think about your own estate plan as well. Check your own beneficiary designations. Make sure the accounts that you own have the right beneficiaries listed and have the right titles on them as well. Because the difference between having a beneficiary and not having one is the difference between money flowing directly to your family or money sitting in the probate process having additional expenses. That's a planning decision, not a legal accident. So work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.